Hi, I am recording this video in April of 2025. And at this moment in time, my law firm seems to get a lot more calls than we used to from homeowners who are troubled by the fact that their real property taxes are going up so rapidly to quite significant amounts, affecting the owner's ability to make the mortgage payments and hang on to their property. Some of these situations, it seems like the majority of the situations, are calls from people who find out that they own property in something called special taxing districts. And so, they're mystified by what they are, and they're trying to figure out about how to get control over that. And so that's what this webcast is about. It's about what people buying into developments that were developed through special tax districts, what they need to know, a little bit about what they need to know, just scratching the surface about what they need to know. So the first thing that I would like to say is that in this time period that we're in the 2024-2025 time frame, everybody's real property taxes, almost everybody's real property taxes have been going up. I mean, the property that I own is not in a special district, and our real property taxes have been going up. So misery enjoys company. And the mere fact that your taxes are going up are not merely because you're in a special taxing district. There are other things, just such as inflation, just such as the rising assessed value of your property that causes your taxes to go up. But special districts are the topics of this webcast. And so let's talk about the peculiarities, the special features, some of the nuances of special tax districts. All right, here's a concept for you. Imagine there's a developer, and the developer is taking something that was a farm or something that was a ranch or just unused land, and now developing it. Developing it means getting the property ready for homes to be built on the property. Well, there's a lot of infrastructure costs involved in developing the property. You got to put in roads, and you got to put in storm sewers and sanitary sewers and gutters and sidewalks, and all of that stuff is phenomenally expensive. And so how do you raise the capital? Well, starting in about the 1990s, it became more and more common that developers raise this capital by forming a special district, a special taxing district. And in a way of thinking, people who are technicians in this area would laugh at what I'm about to say, but the way of thinking about it is it's kind of a limited local government that has the ability to issue bonds. These bonds are then sold to investors, and the capital, the money that comes in from these investors, is used to build the infrastructure. Well, the investors expect a return on their investment. They expect to be paid back their principal eventually, and they also expect to receive interest on the capital that they have invested. Well, where is that money going to come from to pay the interest and pay back the investors? And the concept is the special taxing district has the ability to add a new row on the assessments against the property, and essentially tax the properties sufficiently to pay for to pay the bond investors. So let me lay some easy math on you. I'm not using a visual to show you the math, but the easy math is imagine that there is a developer who is developing some ground, and the development costs, let's say, are $10 million. $10 million. And I'm just picking numbers that are round numbers. It's easy to do the math on. And let's say that the development is designed for 500 homes. Well, if the market absorbs the homes as quickly as the developer projects, and you take 10 million divided by 500, that turns out to be $20,000 per property. And perhaps the $20,000 per property, the debt essentially that needs to be covered on an average price basis for each property is a reasonable amount. But suppose the market does not absorb the product the way the developer and the bond investors expected, and instead of the market absorbing 500 units over a given period of time, there are only 50 people who buy into the subdivision, and then the market stalls out, and people aren't enthusiastic about it. The buyers are not as enthusiastic as the developers and the bond investors thought. Well, now you have 50 homeowners supporting the debt obligation of $10 million. And instead of it being a burden of $20 million per house, it's a burden of $200,000 per house. Well, who takes the risk of that? Well, at least initially, the way the law is sort of written is the homeowners take the risk of it. The special taxing district has the authority to raise the tax rates and the obligation to raise the tax rates in order for the bond investors to pay back. Now, at the end of the day, there's actually some practical limitation on how much the taxes can be raised, regardless of what the law says, because the market doesn't care what the law says. If the taxes get too high, then people aren't going to buy into it. And that means it's going to be harder to sell units, and that'll cause more existing owners to default and not pay their taxes, and then there'll be fewer people paying their taxes, which would require the raising of the taxes even further, which would cause more defaults, and we call that scenario a death spiral. And the bond investors and the district have an interest in avoiding the death spiral. So that creates a cap on infinitely raising the taxes. But nevertheless, there can be a lot of pain between the taxes that the buyers expected and the price at which they're raised to. So how can buyers help manage this risk? Buyers of new property manage this risk. And first of all, I would say that if somebody's buying new right now in Colorado, there is not a way of completely eliminating this risk. And the reason is I haven't done the deep dive on it, but my understanding is that virtually all new construction is occurring in developments. New construction and new developments is happening in developments that are financed through special districts. So what can buyers do? Well, they can do their homework on the special district, and there's a law out there, and I'll give you the name of the law in just a minute, that requires all special districts to have websites that post the official financial records of the special districts on the website, and your buyers can look at it. Well, what are your buyers supposed to look for? Okay, number one, we can't cram a whole financial analysis class into a YouTube video. Number one. Number two, it is way beyond the scope of what real estate brokers are licensed to do for real estate brokers to do the deep dive in the financial analysis. So I can't tell you how to do the financial analysis, but nevertheless, there's a few red flags that can be spotted. Let me just scroll my notes a little bit. So number one, look at the existing real property taxes, because if the existing real property taxes are sufficiently above market, that is a red flag. The developers don't want that. That makes it harder to sell product. So if the taxes are above market taxes, it suggests that they're above market rate real property taxes because the developer has had no choice but to raise the taxes to cover the debt obligation. Another is to look at the history of the rate of increases of taxes, because if they're accelerating rapidly, that suggests there's a problem. Another thing is there should be auditors' reports in the financial information that is posted on the website, and people who are buying in can examine that and see if the auditors, reflect signs of concern that without substantial increases in the taxes, the bonds are going to go into default. Look in minutes of the board meetings. If the minutes reflect that the district is having to contemplate substantial increases in taxes beyond inflation, that's a concern. And then another thing that can be studied is what was the planned absorption rate? Because if the planned absorption rate, the rate at which the market absorbs the units, was supposed to be like this, like 100 the first year and 100 more the next year for a total of 200, and then 100 the next year for a total of 300, and it's actually selling like 50 plus 50 plus 20 plus 10, that means fewer improved properties are going to be bearing the burden for that $10 million of infrastructure. All those things are red flags. Is that a complete list of how to discover all the problems, financial problems of the special district? No, it is not a complete list, but it's enough to do a little good. What if buyers want to dig deeper? Find experts, forensic accountants who can help you with a deep dive. Probably not a practical expense for most homeowners. If you're just going to hold your nose and buy in, at least know you're buying into big risk. And where do you find these websites? Well, you're supposed to be able to find these websites in the Real Estate Commission approved contract. There is section 8.4 of the contract that requires the contract to identify the URL of the district. Having said that, I think, just Googling the district and being careful, how many, these special districts might have names that are similar to each other. But you'll be able to find it if you're on the buyer side. When you're on the listing side, you would like to have that website before the property is listed so that it can be in your MLS remarks. Hey, buyers, when you submit your offers, make sure you put this URL in the blank at the end of section 8.4 of the contract. All right, ladies and gentlemen, that's all I got for you about how buyers who have not yet closed can try and protect themselves from risk of taxes going up higher than they expected. It's complicated, like everything else. We live in a complicated world. We ourselves make it complicated. Be careful out there.